Well, thank you, and good afternoon, and welcome to the DoubleLine webcast with Jeffrey Sherman. Title of today's webcast, The Great Rotation. A few housekeeping items. The webcast schedule, you can see here on October 11th, Mr. Sherman will be back up for asset allocation webcast, and then October 25th, our smart beta webcast with portfolio managers Jeffrey Mayberry and Sam Lau. And then on November 8th, we'll have our international fixed income webcast with a series of portfolio managers from our emerging markets and global bond area. If you'd like to see the rest of the 2022 webcast schedule, please go to doublelinefunds.com. You want to receive today's presentation slides, please go to the webcast player and click on Request Webcast Content. You can also follow us at our Twitter handle at DLineFunds, and then we also have a new YouTube channel, youtube.com/DoubleLineFunds. Would like to highlight some of DoubleLine's thought leadership in the media. The other YouTube channel that we have is /DoubleLine Capital. And here you can see our very own Ken Shinoda with Channel 11. You can view that there at that YouTube channel. And then we have a new video series called PS Perspectives. And that's hosted by our product specialist team. Will give us latest thoughts on the financial markets, macro events, and drivers of return in various segments of the market. The widely acclaimed Sherman Show podcast with our Deputy CIO, Jeff Sherman, and portfolio manager, Sam Lau. And then the other podcast, Monday Morning Minutes, also with Sam Lau and Jeff Mayberry. Today, we'll be reviewing our new ETF complex. We have two new ETFs that we launched March 31st of this year, so a little over 5 months. Here you can see the DoubleLine Schiller US Equities ETF, the ticker CAPE, and the gross expense ratio at 65 basis points, the benchmark being the S&P 500. Portfolio managers are Jeffrey Gundlach and Jeff Sherman, with the CAPE Index co-creator, Professor Robert Schiller. And then the DoubleLine Opportunistic Bond ETF, the ticker on that is DBND, also launched March 31st of this year. The gross expense ratio, 50 basis points, the benchmark, the Bloomberg US Ag, and portfolio managers Jeffrey Gundlach and Jeff Sherman. Real quickly on the standardized performance, this goes through August, so 5 months, and then the standardized performance on the NAV minus 10.42 versus the S&P 500 at 12.10. So an outperformance of 1.68%. And then lastly, standardized performance on DBND, DoubleLine Opportunistic Bond ETF, minus 3.89% versus the Bloomberg US Ag at 5.12%. So without further delay, I'll turn the webcast over to Mr. Jeffrey Sherman.
All right, Ron, and thanks for that today. And what a day in markets once again. And I just came off of CNBC about an hour ago, just talking about what's going on in the market. So we'll cover some of that, what we're seeing in the marketplace. We're going to start with the macro landscape, but really challenging time in the bond market. And from our internal estimates and what we see on the Bloomberg US aggregate after today, we're probably looking to be down, the index, I should say, not DoubleLine funds, but the index itself being down over 15% on a year-to-date basis. So the carnage continues in that market. So let's talk about what we can do about it at this point. And we titled this webcast, The Great Rotation. Shout out to one of my colleagues who came up with the idea, and just thinking about, it is time to be rotating throughout various parts of the marketplace. And so we heard about this phrase many years ago where people were talking about buying stocks for safety and capital and income, and, avoiding the bond market as not having the potential to either generate income or capital gains. And what a difference really 12 months makes today. And so what I want to talk about is the great rotation and some potential ways to really help stomach some of the volatility out there in the marketplace, and what really the opportunity set that lies in fixed income today. And as Ron said at the beginning, I'll be back in 2 weeks talking about the same topic again. Probably have a lot more updated data, just given how fluid markets are. But I think it's very important to really assess some of the landscape today, what the setup looks like, and how to potentially capitalize on that to try to claw some of this returns back. So as we all know, we've seen the GDP prints from earlier in the year The first 2 quarters have indeed shown us a negative real GDP print. Some people call that the heuristic for thinking about a recession here in the U.S. But what's very interesting about this, if you look at GDP over the long-term trend line, is that there was a very consistent trend line growth in the post-World War II era. And if you started from about 1950 and you ran the trend line, you would see there, this is done in logarithmic scale because of the long time frame and compounding, but you can see there that the growth rate was relatively consistent. And something really changed at the global financial crisis. We went through quantitative easing. We threw lots of debt at the marketplace, trying to manage interest rate policy to try to stimulate growth. And notice the slope of that line. Not only did it deviate from that dotted line, the long-term trend, but notice that the slope of that line decelerated. And so our growth potential in the QE era went down meaningfully. And so you can see here, even with all the policies we enacted and the significant drawdown we saw during the pandemic, we just really got back to that trend line growth, not the post-World War II era growth rate, but really where we are from that kind of post-GFC era. And unfortunately, third quarter GDP, if you take a look at it, the estimates, there's updated estimates with some new economic data today that the GDP now estimate is for a paltry 30 basis points on an annualized basis for the third quarter. So definitely the economy has kind of hit stall speed here. The question is, with the current level of interest rates, the Fed's hawkish behavior, will that allow us to continue to get back to this trend line growth, or is it going to derail the system? So let's look at what the economic data is showing us, and let's look at how markets have responded. So again, to put it in perspective, the drawdown in GDP, what you see here is the last couple of recessions that we've had, the drawdown in GDP has been more meaningful than what we've seen in kind of the prior recessions. And so if you think about what's happened, you can see there are blips down in GDP. Most people are amazed when they go back and look at the recession from the tech wreck and what we saw in the early 2000s. But it wasn't really a broad-based economy. It was just the financial markets were really in ruin. And then we had some challenges late in 01 and early 02. But you can see here that we're kind of on pace for that. Is it a head fake from the recession? Potentially it's starting to look more and more likely by the day that U.S. economy is indeed in a recession. And there are some bright spots in the economy, but broad measures are definitely indicating that we are continuing to slow down here. And one way about thinking about this, since GDP is a backward-looking indicator, is to look at something called the economic data change. And Citigroup puts together these time series. What they do is they take a look at an amalgamation of various economic data, and they compare what the readings are on that economic data today relative to where it was on average over the last 12 months. So you can think of it as kind of a velocity or a signal saying, where are we today relative to where we've been on average over the last 12 months? And not shockingly, given the amount of stimulus we put in the marketplace, we did see an uptick in economic activity due to the monetary and fiscal stimulus. But at some point, it's going to be hard on a comparable basis. And so we've seen that deceleration throughout the year. And if you look at the black line, which shows the U.S., you can see it's really been this stabilization of continuing to underperform where we were. Not shockingly, we had a very high growth rate last year. We had some record corporate profits out there as well. And so it's a very difficult environment to have on a year-over-year comparison. But I guess the one bright spot you could say here is looking at that orange line is that there is someone that is really accelerating, and that is China. And so again, just given the amount of lockdowns they've had, the open the economy, close the economy that they've seen there, and by reopening the economy, they're starting to get a little more data. Yes, there's been some credit impulses there as well, but potentially, maybe China can help stave off some of the stuff we're seeing on these global issues. But again, let's focus back here more in the U.S. because that's really where our portfolios are centered for this webcast today. And so if we look at also the data, another way of thinking about that, remember markets price things from an expectation standpoint, right? So it's not always about how the data performs, but data performs relative to expectations. And so Citi also puts out a commensurate data series where they measure the surprise in the data. And notice that the economic data was surprising to the upside in the first quarter of this year. We hit that rough patch really just kind of towards the end of the first quarter. where it kind of underperformed expectations in a meaningful manner. And you could argue that maybe we're just kind of on par with expectations right now. So again, maybe the economy is doing a little bit better than people are thinking about it in there. But also, this is an example of what's going on with people thinking about markets as well. And so remember, this sentiment can be a very heavy overhang in the marketplace. It drives euphoria, but it also brings kind of negative sentiment into the market as well. And so that negative sentiment is indicative of what we're finding from economists out there. I know it's always dangerous to rely on forecasts from economists. But what I wanted to show this chart for a reason, and I like to show this chart, is to remind everyone what GDP growth looked like in the post-GFC era. And if you look at the ranges there from 2010 all the way through like 2019, where we had the greatest economy ever, as some people called it, you had a growth rate between 1.8% and 2.9%. So this real GDP growth of 4, 5, 6, that's something we haven't seen since the early 2000s and the late 90s. And so again, I think if we think about our potential, our capacity, looking at some of the overhangs we have within the demographics within this country and the lack of immigration, what you'll see here is that, getting back in that range is probably where the optimal capacity is. And you see what happened in 2020. We overshot back with all the stimulus in 2021. But look at the deceleration of these forecasts in 2022. I'm not even going to look at the purple line on 2023, but notice here that you're seeing that, again, below trend line growth. And you even heard this from the chairman at the FOMC meeting last Wednesday when he put out that, when he said that, not only do they have these higher dot plots, they're forecasting lower growth rates. They think inflation is going to come back in line. They're forecasting higher unemployment. So they are indicating that they believe that the policies that they are trying to implement will put the brakes on things. And that's because they want to be perceived to be inflation fighters. And so you're seeing this degradation in the data set, which means you should be starting to think about recession for 2023. And again, whether or not we hit it in 2022 or not is to be seen. It'll rely significantly on the consumer and the labor markets. But at this stage, our antennae are up significantly in thinking about recession risk in 2023. And the good news is, if you're thinking about that, we do have some ideas out there and things we've done to the portfolios of late that we think can help kind of mitigate some of that downside if indeed that starts to play out, that thesis plays out. And so, again, GDP is a very slow indicator. I remember Chairwoman Yellen said it was a noisy indicator. I don't know if it's very noisy, but indeed, it is lagged, right? And we only get it on a quarterly basis, and we get some revisions along the way. So the Fed did create something out of the New York arm of the Fed called the Weekly Economic Index, which measures overall economic activity. And why I like this indicator is that it gives you a sense of directionality of GDP. And the bad news here is that we are continuing to decelerate. If you think about the year-over-year numbers within them, you have the two negative prints from the first 2 quarters of this year. But again, you see that deceleration going down as well. So I think this is why investors should be thinking about potentially, are we going to enter an economic recession here in the U.S.? Some argue we're already there. It doesn't show completely that we are there yet, but there's a lot of signs of some harbingers of bad news out there. So again, given some of the yields and things we find in the marketplace, we do think that there is the potential to benefit, or at least try to insulate investors' overall portfolios against some catastrophic events. And another kind of harbinger of bad things to come is something called the leading economic indicator. And the leading economic indicator is, again, another amalgamation of metrics. It uses 10 metrics together to come up with what they call the leading economic indicator, and that's the red line. Another thing to kind of watch to see the directionality of that is to look at the leading economic indicator change on a 6-month basis, annualize that to kind of see the directionality. And you can see here that whenever we've went below zero, we haven't always went into a recession, but when you've done so in a value roughly in this range we see, it usually leads you to that recession. And so again, with this deceleration at this point in time, it does look like potentially a recession is on the horizon. And so this is a chart we've used for a while now, just talking about how accommodative the Fed had been relative to essentially the inflationary environment. And so this is calculated, the real Fed funds rate in this graphic is calculated as the current Fed funds effective rate less the trailing 12-month CPI. And why I think this is very important today, if you listen to what the chairman said during the Q&A at the FOMC last week, he said that we need to get U.S. interest rates to be positive on a real basis across the curve, right? And that includes the Fed funds rate. And so historically, when you think about the Fed funds and fighting inflation, the Fed funds rate usually goes above the inflation rate. So the bad news is there's a big gap here. You can see 590 basis points or so. But the positive news is that inflation is likely to start to gravitate downwards. There is going to be some pressure on some of the inflation data, which again has elevated our probability of recession here at DoubleLine. But ultimately, it's not that the Fed needs to get to an 8-9% kind of Fed funds rate. If those two things kind of mesh together, potentially the path that the Fed laid out is one that will get you to that very restrictive policy level. So let's talk about inflation. It's on everyone's mind. It's what's rattling the bond market at this stage, where we were told for 18 months that it's just transitory, and now all of a sudden it's like a 5-alarm fire out there, where ultimately that the Fed is all hands on deck trying to fight this with the tools that they have. And so, again, I won't harp on this slide. Just shows that no matter what time series you use, whether you use things like the trim mean, you try to take out outliers, use median prices, use CPI, use the Fed's measure of PCE, all the inflation measures are above levels we've seen in roughly 30 years if you took this time series back even further. But more importantly, they're all in alarming territory. So this is why the Fed is acting so responsive in this manner. And again, if you look at the components here, and why we focus on this is that the belief of the inflation was that it was driven simply by goods. And that is true. If you look over the last 20 years, you'll see that core goods were actually in aggregate in a deflationary environment. Now, some people will get puzzled and scratch their head when I say that, because it's well, cost of goods didn't go down. Well, the quality of the goods went up, something that economists call hedonic adjustments. So it does look indeed deflationary if indeed the price stays static. And, there's talk about this being the Amazon effect, or the decimation of mom and pop retail stores and the commoditization of that kind of world. But you see here during the pandemic that our consumption of goods, with the fiscal stimulus, with the amount of support out there, with people not going into the office and staying more at home, our goods consumption on a price basis went up massively. But notice what's happened all of a sudden is that core services now is starting to really converge with these goods. And this is really a bad sign. Now you can think, okay, well, core services, it's things that, aren't goods, it's things that we do. And that's right. And so potentially in here, there's the revenge travel that people talk about, that I don't care what the cost of the airline ticket is, or the hotel stay, or gasoline prices. I'm going to go out and spend money. And that is part of the services. But the largest part of services is actually the housing market. And we've been harping on this for a couple of years now, that just wait until the inflation data catches up to what we've been seeing in the rent and the housing markets. And you're starting to see that. So core services, even with kind of a moderation, is likely to continue to keep inflation somewhat elevated. So we put together this graphic on the next page to kind of show that. And so if you break down, instead of just using services and goods, so the gray shaded area is core goods. The yellow and blue is an aggregate core services, right? And the blue is just shelter. So the yellow is services X shelter. So why I put this together, just to show you the impact that housing has on the inflation number. And you can see services is historically, at least over the last 30 years, what has driven the bulk of the inflationary environment. And so again, this is kind of an aberration from the good side. But what I want to illustrate here is that the shaded areas are the weight of that component inside of CPI times that CPI rate within that basket. So even today, let's say that all of a sudden that goods inflation goes to zero, goods prices flatline from here, right? And core services X shelter flatline from here. And you can notice that yellow area is typically pretty positive, but again, say it flatline, well, shelter alone will be driving a 2.5% inflation rate. So even if you zeroed out the other components, we're still at a level that's probably above the Fed's comfort zone. And so again, with some of the lagged variables that go into rent and owner's equivalent rent within here, what that means is that this number is likely to remain elevated irrespective of what the Fed is doing today. And we saw mortgage rates now hit over a 7% or 7 handle today in the marketplace. It's undeniable that there's going to be some pockets of the housing market that are going to slow in a meaningful manner. But in general, this is a lag time series, so it's going to take time to filter in. So that's the bad news, and what likely keeps the Fed potentially more aggressive than they need to be. If you go back 2 Fed meetings ago, the Fed chairman said that, with where we are with rates, we're around neutral. And neutral is where they think that policy is just right. It's the Goldilocks scenario. And the market over the next few days treated that as it was like the Fed's almost done with its hiking. Nothing's going to change. What a difference 2 months make, right? If you listen to the Fed chairman from last week, he is not talking anything like that, talking that we've got to remain restricted. We've got to be harder and tighter in our policy. And so that's what's happened to the reprice of the bond market as of late. So the good news on the good side is that, some of the supply chain pressures have started to ease here. You can see here from these conditions, yes, they're elevated relative to history, but this is likely a good thing on the good side of the equation and to help kind of bring some stabilization of prices on that part of the consumption. Another positive attribute so far in the economy is that manufacturing services, these manufacturing indices, or what they call the PMI indices, still are indicating that we are in expansionary territory. Yes, there's been deceleration. That's why you see from those economic data change series I showed earlier that they've been trending in a downward direction. But you can still see here from the last couple of prints that services is still hanging in there. So these are what we call diffusion indices. Therefore, it just talks about the amount expanding versus the amount contracting. So it does signal that the economic activity is still there, albeit on a muted basis. One thing as you think about CPI is you can think about input costs. And so there's another thing that comes out from these ISM time series, the ISM, where they calculate the prices paid. And when you think about the prices paid, these are the input costs. So it tends to be a leading economic or a leading indicator of what's going to happen into CPI. And you can see here that this data set has tended to roll over as of late. And so this is the one thing to be hopeful for, is that potentially some of the input costs decelerating back to these kind of more traditional levels could potentially slow down inflation as well. But again, as I showed you, because of that housing market component, there's still going to be a little trade-off on that side of the equation. So there's signs of positivity that inflation is indeed rolling over, but some of those stickier components outside of inflation may continue to run or may continue to keep inflation elevated. I think at this stage of the game, if the Fed saw like a 3% inflation rate, they'd be ecstatic, right? They would say mission accomplished. We're getting the job done. Our policies have worked. But in order to get to that level, you've got to have a lot of consecutive months kind of with a zero or negative inflation print. So what does the bond market think, right? So if you think about the bond market, there's something called the price of inflation. It's called the inflation break-even spread. This is as an investor, since you can buy inflation-protected securities or TIPS, it's the differential in inflation rates that make you agnostic from buying a TIP security versus owning the actual nominal treasury, or what we call treasuries. And so the bond market is starting to be convinced that break-even rates are going to get back kind of in line with these more, it's the upper end of historical standards, but indeed it is going to start to get back to the levels that the Fed wants. Now, if you look at 1-year break-evens, and again, they're more sensitive to commodity prices, or 2-year break-evens, you see that ultimately the market is priced in like a 1.6 or lower inflation rate over the next couple of years. So the market is starting to think that ultimately these policies, or again, maybe it's a slowdown in the economic activity as well, that's going to drive that down. So again, that is a positive attribute as a bond investor. If you believe that the bond market has the price of inflation right, that tells you that today you can buy securities that generate real positive rates of return. And again, if you don't believe me, go directly into the TIPS market. You can buy a 5-year TIPS today. They will give you a 1.84% inflation rate above whatever inflation is for the next 5 years. So you can guarantee you will outperform inflation by buying TIPS securities. But what you see here is the massive repricing of the 5-year part of the curve, as well as the 10-year part of the curve when it comes to TIPS yields. And why this is important is the directionality of real yields is what sets a lot of risk asset pricing and also sets equity multiples as well. And so you can see here that as we get this sharp repricing of real yields upward, it's had pressure on the equity multiple. You had the deceleration yields. That's when we had the rally. And all of a sudden, again, now the market repricing real yields to levels we haven't seen really since back in like 2011 is getting to the point where it's having an impact on risk markets once again. And so again, it's very important to focus on this part of the curve to really understand what's driving that part of the multiple. So those are some of the negatives. We know that the housing market, the labor market continues to remain strong. If you look at non-farm payrolls, we've seen the growth rates the last couple of months. Some people have been scratching their head about, some of those prints given the data set out there. But what you find is that we now have more workers than we had prior to the pandemic back in March of 2020. And so you started to see labor participation rates go up. This is good news. However, we all know, just like Fed policy, I saw Charlie Evans out this morning saying, reiterating that policy operates with a significant lag, but so does the labor market, right? Usually companies don't lay people off because they think a recession's coming. Usually the job losses come once we're already mired in that recession. So the other thing to watch on this side is watching unemployment claims. They come out every Thursday. They come out with a 1 to 2 week lag, depending on which data series you're looking at there. And so far, they've been relatively muted as well. So labor participation has picked up. The amount of employment creation and job creation has come back to kind of pre-pandemic levels. Yes, we're not back on that overall trend line, but it usually takes a significant amount of time post-recession to get there. Look at back in 2008. When we went into the recession in 2008, it took almost 6 years to get back to that pre-peak level in terms of the number of people employed. This time it only took roughly around 2 years to do so. So again, there is something about this receleration and the amount of money spraying we did to get there. And so what is probably also on Jay Powell's mind, and he speaks to this, so I know it is on his mind. We don't talk personally, but I listen to him every 6 to 8 weeks at the FOMC. And he's talking about the imbalances of the labor market. And what he's talking about here is that there's too many job openings for the few number of people who are employed today. And that gap, you can see there's about 5 million incremental jobs that are sitting out there that are not, we don't have enough workers for. And so when he talks about supply imbalances, you could say, well, potentially we can get labor force participation up. That can come from more people in the workforce. Maybe, where we had dual income households went to single, they go back to dual. We have some immigration. That's the nice way to think about, getting balance back in the labor market. The other way, and the way it can happen very sharply, is have fewer jobs. And so that is increase in the people looking for work converging with that blue time series. And so this is the thing to watch as well, because as long as there's this gap here, it's likely to empower the Fed to continue to remain very hawkish in their policy. And this is translated to wage growth. Not shockingly, when you have an imbalance in the marketplace, you're going to have to pay for talent. And so we all know that it's a challenging year in financial markets. There's been good wage growth out there across the markets. Maybe not in the financial services industry. It's not a good place for wage growth right now. But this is also causing concern from the Fed. And so even though these are positive attributes, this is what's emboldened the Fed to continue to be so aggressive. And, essentially, if you look at their dot plots, and I'll show this in the next section, they're telling you that there's another 125 basis points of hikes coming. So this is kind of the setup we have right now in the U.S. economy. Let's talk about what it's done to markets. And this is a chart that just puts into perspective how painful this year is. And this is only updated through yesterday. The bonds were off again today. The ag was down a little bit more. So I think we're down probably about 15.5% on a year-to-date basis through the U.S. aggregate index. The DoubleLine funds have done better than that, especially in the intermediate term category, where we're trying to risk manage this environment. And I'll talk about some of the opportunities we're trying to take advantage of right now. But notice the perspective here. I mean, not only is this the worst bond market that we've seen since the inception of the U.S. aggregate, it's leaps and bounds worse. People talk about 1994, what a horrific experience that was. I mean, that pales in comparison here. Being down at the end of the year, being down about 5%. I think we'd all take that. At that point, the bond market was only down 5%. And so let's look at what the drivers are. So if you look across the market, there's a lot of carnage in the bond market, right? Whether it's treasuries down 13%, agency mortgages down 14%, corporate bonds down 18% in aggregate, triple Bs, the lowest credit quality of IG down, and that number's over 20 today. You look at emerging market debt down 22%, corporate bonds in the below investment grade space doing a little bit better because they have a little bit less interest rate sensitivity, only down 14%. It's a wonder that managers are surviving. Well, what's happened is that if you own some of these floating rate components, things like bank loans, they say leverage loans on here, the higher quality has done relatively well. Things that are shorter duration in nature, like the structured products and the securitized space, have done quite well. CLOs, one of the darling childs this year as well. And, non-agency RMBS, if you own some of the legacy ones, just because of the prepay environment and their discount securities, they've done relatively well. So you put it all together, it's been a very, very challenged portfolio, and you really have not reaped the benefits of diversification. And why that is because we've had really almost an unprecedented move in the rates market. And so I was digging through the data this morning, trying to see, what years have we seen bigger rate moves than we have in this year? And there was one back in the early 80s where 10 years went up a little bit more. They actually went up about 450 basis points on a year-to-date basis, where we've only seen this year, like a 300 basis point rise in the 10-year. But look at the 2-year. The 2-year went from a paltry 10 basis points. In fact, at the beginning of the year, it was it was sub 50 basis points. And here we are today, seeing a rate rise of almost over 400 basis points. I think it was actually around 25 basis points at the beginning of the year. So a 400 basis point move in the 2-year, that's directly correlated to Fed policy. You always hear Jeffrey Gundlach speak about this. The Fed is what's setting expectations to that as well. It's what allows the Fed to continue the hikes. And that's what's been the pain over the last couple of weeks. Notice that receleration from the pivot point where the July Fed meeting, the FOMC meeting, where the market interpreted Jay Powell as being practically done. Very dovish interpretation. We got down to almost 275 on the 2-year. Since that point, we've went up almost 180 basis points over the course of 2 months, right? So yes, if you use technicals, bond market's oversold at this point in time across the entire curve. Just look at that. Everything is repriced. Yes, we have an inverted yield curve. Again, another one of those harbinger of potentially, recessionary watch on the horizon. But in general, this has been a very, very fast sell-off. And so short term, we think that, again, rates are oversold a little bit. They're definitely very oversold across this, whether it's 2s, 10s, or 30s. And there is the position to potentially have a short-term tactical a reversal. And again, this is all going to depend upon where the terminal rate ends with Fed fund policy. The market right now has about let me just show you. The market right now has about a 4.6% terminal rate on Fed policy. So what you can see on this chart here is the expectations of the market on where Fed policy will be at each of those FOMC dates. And notice that the market listened to the dot plots. The dot plots are what kind of rocked the bond market last week, where the Fed was conveying that they are not slowing down. That they're saying another 100 to another 125 basis points of hikes between now and year end. And the bond market listened, right? Notice that a 425 year end, that's a 75 and a 50. Maybe it's a 50 and a 75. Maybe it's 100 and a 25, but that's how the market's pricing. If you look here, it's a 75 and a 50. Then there's one more hike early next year, and then they're going to have to slow down. We did some analysis on kind of historical Fed fund target rates. Once they get to the upper end of the range, how long do they stay there? It's not a hugely robust sample. It's got about 11 data points. And you find that on average, it's about 9 months they stay at that terminal rate. In the last cycle, if you think about when they were hiking, they hiked through December of 18, and they were cutting rates by March of 2019. So it's only 3 months in the last cycle. So the market tends to look at the last cycle as being more indicative of likely what this one looks like. But you can see here that essentially we're front loading the hikes. It's a lot of hikes, right? I mean, 425 basis points of hikes, or 400 basis points of aggregate hikes this year would put it on par with one of the largest rate hikes that the Fed has ever done. and that goes back into the Volcker era. So what this done is this has repriced the front of the curve. It's brought the rest of the curve with it, and it's really changed the profile of the bond market. And so let's just look at the index, right? If you look at where the index was at the depths of the crisis back in 2020, you had a yield of around 1%. Today, the index yields 483. And so, again, remember the ag index is roughly 30% treasuries, 30% corporate bond, 40% treasuries, 30% investor-grade corporate bonds, and 30% residential mortgages. And so with that mix shift, that gets you to a yield of about 483. Now, if you think about what I was showing earlier with the expectations of inflation, and let's say you can own this portfolio for, let's say, 5 years, right? And again, yields didn't move. You were able to reinvest at 483. 483 is a great number relative to the expectations of inflation. So even the index today is getting to a point where it's starting to offer some very relative attractiveness. And what I'll show you is that with careful risk management, as you heard at the top of the hour, our philosophy about running fixed income portfolios, we think you can do significantly better than this in terms of the yield profile with taking commensurate risk in the marketplace. And so why I focus on yield is that if you think about the yield environment, it's really a good predictor of forward-looking return. And so just trying to think out a few years, what we did is this is something we put together a couple years ago when we had client meetings talking about this very paltry yield in the marketplace. We said you've got to be careful with the duration of the portfolios for this reason. And so you can see here that the blue line shows you your starting yield, and then what the gold line shows is what your commensurate or what your annualized rate of return is over the next 3 years. So it's the three-year total return. And you can see here now with the yield that's being offered in the marketplace, now you get to the point where on a prospective basis, you start to feel like you can actually generate some rates of return. So again, it's on an index basis. You can see the yield at its level. This was month end. That's why there's about a 70 basis point differential there. So you can just tack that on there. It implies that a 3-year annualized return, even on an index product in fixed income, could be closer to 5% on an annualized basis. So sounds pretty attractive, this environment, especially with the potential to generate capital gains if yields were to rally, but also just earning the aggregate carry at this point. However, again, you tune into DoubleLine to listen to what we're thinking about the fixed income marketplace. And if you just focus on the things that are inside of the Barclays US aggregate, that is what you see in those gray areas. The lighter bars are where we were at the beginning of the year in terms of yield. The darker bars show you where we are today. And we drew a dotted line across the highest yielding part of the investment-grade corporate bond sector and compare that to where we are into other parts of the market. Things that we use across our suite of fixed income sectors when we think about asset allocation. And notice here, the amount of yield that one can get by taking some of these non-traditional credit risks that we say. They're non-traditional because they're not in the index. They're things that we all know: high yield, bank loans, emerging market debt, corporates, sovereigns, asset-backed securities, things like commercial mortgages, CLOs. So notice here, when you get into the investment grade part of the structured credit market today, you're talking about yields in the 7, 8, 9, almost 10% range. So using these in a very careful and calculated manner and pairing that with some of the duration risk, we think is a very prudent way to approach the landscape today. So that leads me into our strategies. So as mentioned by Ron at the beginning, we launched the ETF complex at the end of the first quarter of this year. We have one on the equity side, CAPE, C-A-P-E. We have one on the fixed income side, our opportunistic bond strategy, DBND. And so let me talk about DBND first. So again, those of you familiar with us, this is a process we follow for all of our multi-sector fixed income portfolios. It's something where you have the stability of a team that's been around. On average, we've been working together for over 20 years. This is something that we've been through many cycles. We have a lot of experience doing that, and not just doing it, but also doing it as a team. And so again, this is a very active product. It's active from the standpoint of thinking about the macroeconomic landscape, all the charts I showed you. When we have our monthly committee meeting where we dictate policy for these portfolios, we look at those charts plus probably another 80 to 90 slides as well, things that really we believe drive the overall fixed income landscape. So we pair that macroeconomic outlook with what we're hearing from all of our sector specialists. And our sector specialists are the portfolio managers. These are people that have been running money in these spaces 15, 20, 25 years that can give us an assessment of what the fundamentals look like, what trends look like in their markets, what the issuance looks like, what the credit quality is doing, what the migration has happened in their areas. And we pair all that together to give us a decision-making process where we think about setting a horizon over the next 18 to 24 months. And that may seem like a challenge today. We all know it is quite challenging thinking about that environment, but this gives us a chance of having better success of not trying to worry about the day-to-day wiggles and jiggles that go through across the market. And so, again, it's a process that permeates all of our actively managed products. And so another way of thinking about this is I showed just the outright yield in the marketplace. But another way of thinking about that is putting us on two parameters, yield versus duration. And so the horizontal axis is the duration or interest rate risk, and the vertical axis is the yield in the market. And you can see here that gray oval that's in the middle, that's circling essentially the things that are within the Bloomberg US Aggregate Index today. And you can see that there's ways that you can either reduce one's interest rate risk or you can increase yield for commensurate interest rate risk. So in this two variable framework, and again, you have to assess the credit worthiness. And again, that's where having a significant experience and a deep team, our investment team is over 100 individuals when you include our risk analysts today. So you have people who are experts in these areas helping analyze this. And then at the portfolio level, we're putting it all together in this risk managed framework. But just notice if you open up the universe outside of what's in the Bloomberg US Aggregate. One day I'll stop saying that. I did stop saying the Lehman Ag, so one day I'll stop saying Barclays. But if you look what's outside of the Bloomberg Aggregate, there is significant opportunities to reduce interest rate risk and or increase yield. And so that's why we use a more diverse set. We don't believe in indexing products in the fixed income marketplace. And so this shows you kind of what that landscape looks like today. Yes, you have to exchange some credit risk in some areas, but also most things I show on that screen, especially the gold dots, are all carry investment grade ratings. Here's the parameterization. As you'd expect in an opportunistic strategy, it's quite wide, the bands. We have the ability to go fully into the government sector, if we really, really want to get there. But again, we look at risk return. It's not just only managing risk. Are we being paid for the risk in the marketplace today? And even with the sell-off out there, we've seen rates do look significantly more attractive today. And I'll talk about that in just a second. But also, so does credit. Yes, there's potential for some recession risk. But guess what? Markets are pricing that in. So you don't just want to be myopic and only own interest rate risk or only own credit risk. You want to have that smattering for that uncertainty in there today. And since we launched the strategy, the DB, that it's been a challenge just like the bond market. But as I professed to, the goal is to generate a higher rate of return. So through last night, since we launched, we're about 247 basis points ahead of the ag. It stinks. It's to the downside. It stinks to lose money. But again, we're only given the opportunities that the bond market gives us, right? So that means that, again, that 240 basis points of excess return, we've also done it with significantly less risk. Notice that the standard deviation of our portfolio has been roughly 2/3 out of the index. I don't know when in my career I've seen the ag have that much of a volatility in a short time window of roughly 6 months. But again, the point here is to try to manage through this process, have a smoother experience, help you stick with this process, and again, try to outperform the overall bond market. So, again, it's never fun losing money. There's a reason that we're all fretting around the trading desk. It's not fun to be down, but again, you'd be worse off in an index product today. So what does it look like? What's getting you there? Remember I talked about that with an actively managed product, you could get potentially a higher yield. If you look at the portfolio today on the bottom left-hand side of those charts, you can see that not only do we have a higher yield than the aggregate, but we do it from getting yield from different parts of the market. And so not all bonds behave the same. They don't behave the same at the same points in time. And you can see it's that diversity of different parts of the market that are, helping drive a lower risk. And also we have higher yield potential. So if rates do nothing over the next year, default rates benign, you have the potential just on a yield alone basis, 90 basis points, and that's not with rotation or any type of additional active management. We did lengthen the portfolio yesterday in terms of duration. You can see here as of last night, we have a duration of 5.47 years. That was because of the carnage in the market. We decided that we want to increase our exposure to the treasury market. So we did that last night. And in fact, today we did a little bit more because, again, we think some of these oversold conditions create a trading environment. But more importantly, there's more of these harbingers of bad things to come. And we think that interest rate risk, now you're being fully compensated for taking it. And it makes sense to add to portfolios today. You can see a higher quality market price of our portfolio relative to the index. And again, roughly in times with the weighted average life, but still a slightly shorter duration. And we're doing that through the government sector. We have corporate bonds. We do have some high yield bonds in there, even though we're sitting on, thinking about this recession risk. What we own out there, we think are a higher quality than the market. We think that we can have a better than a market default experience. And by the way, the high yield book today has a 9-handle yield on it. So we're getting to the point now where even if there is some recession risk, there's the ability to weather some of that storm. But the reason we're comfortable with it is, again, owning some of those longer duration assets within the government side of the market. The securitized book is about half of the book. Part of that is agency mortgages. There's been a lot of challenges with the agency mortgage market, but we find there's a lot of great value in there. There's a team that's experienced, been running that for over 30 plus years in that space. We feel very comfortable with that. Non-agencies, I know people are concerned about non-agencies because they see housing. Remember, these assets we own were not originated 1 month ago. A lot of them have, are seasoned a few years. In some cases, we still own legacy assets that were originated pre-financial crisis. So again, even if there is some weakness in the housing market, we think the non-agency side is relatively strong. And then this commercial mortgage market too, as you saw from those previous slides, offers significant pickup there. Some of that's just some headline risk. Our team does a very good job of underwriting those securities, and we feel really good about the prospects of having a really low default environment there. Lastly, asset backs. This takes into account some of the other pockets of the market, things like student loans. No, they're not government guaranteed. We don't have to worry about the President Biden risk there. But we do have inside of there some private loans. You have some consumer loans, a few autos. But we also have things that are hard assets, things that are like power plants. We have electric plants. We have all kinds of like real assets under there that have the ability to have this real asset that can also perform through an inflationary environment. So it doesn't help you on the high inflation environment we have today, but it does help the asset value over time and gives you some more structural protection there. And notice we still have a little bit of cash there. We put some of that to work today. As I talked about, we've had a crazy rate market, and we want to be a buyer of some of this into there to try to help resculpt portfolios. So, talking to the team, talking to Jeffrey, just as we've been navigating this over the last few weeks, just the bond market is really rife with opportunity. So if you're nervous about where the equity market goes, we think a portfolio like DBND is very attractive in today's market because not only do you get paid in terms of yield, you couldn't even get a 5 yield in a diversified portfolio a year ago. In fact, the high yield market in aggregate yielded sub 5 1 year ago today. So there is an opportunity set here. There's a way to really generate some positive real rates of return over the next, let's call it 12 to 24 months. And we think the bond market is really starting to look extremely attractive today. So that's DBND. I'll look forward to the questions in a minute. Let me run through CAPE real quick. Again, for those of you not familiar with CAPE, it's a sector rotation strategy. It's the premise of it is to use the cyclically adjusted price earnings ratio to kind of think about sector rotation. And so the CAPE ratio just says use the current price divided by 10 years of inflation adjusted earnings. And the nice thing about the CAPE ratio is that, it tends to go through a business cycle by having a longer term viewpoint, very consistent with how DoubleLine runs money on the fixed income side. It's something that gives you an assessment of long-term value. And it's historically been used to really look just only at the broad-based market. But Professor Schiller worked with some folks at Barclays over a decade ago. In fact, it's the 10-year anniversary since they launched the index. So We'll be putting out some news on that shortly. But what you'll see out there is that what you can apply at the market level works at any kind of portfolio that distills down idiosyncratic risk. And so what that means is at the sector level, you can apply the CAPE ratio. So on the bottom left-hand side, it shows the CAPE ratio of the technology sector. So think of something like XLK inside of the S&P 500. And you also look at utilities, so something like XLU. And you can see here that relative to its long-term averages, both are above their long-term averages, right? You can just see that from the bottom left-hand side. But technology is really starting to get rich as of late. But you can still see that here, if you only use the view on the left, you would have never bought technology. You'd always been stuck in the utility sector. But the difference here is that by using this kind of long-term average ratio of each sector's CAPE relative to its own average, what it does is it allows you to assess kind of long-term relative value. And so if you look at that, what it looks like today across all the sectors of the market, you can see that one of these things is not like the other. And I'm looking at you, energy. Energy has gotten way ahead of itself. As I like to tell some clients these days that, the energy sector and the CAPE ratio doesn't know about the invasion of Ukraine. It doesn't know about some of the challenges there, but also the earnings haven't caught up with some of that price activity. So if you fell into that trap of chasing this earlier in the year, you're buying one of the most overvalued sectors of the market. But you can see that the rest of the sectors of the market, on average, are actually trading below their long-term averages. And that's what the relative CAPE ratio does. So this is the premise for thinking about how to do asset allocation within the U.S. equity market. So going back a slide, it's a systematic process. It uses those 11 sectors. It calculates those relative CAPE ratios I showed you, and it selects the 5 cheapest sectors of the market. So you start with 11, distill yourself down to 5, and of those 5 sectors, that's what you want to analyze on what you want to allocate to. And of those 5 sectors, because they're valuation based, what we want to do is avoid the value trap that is cheap and getting cheaper, falling knife, however you want to call it. And whatever sector has the worst 12-month total return, you remove that. You're left with 4 sectors, and you roughly equally weight them each time. And so this process is repeated monthly. And what you see here is that it keeps you out of some of these high-flying sectors, like for instance in communication services, which has been a very poor performer this year. We're not in that sector because the momentum is kicking us out of that as well. So it's not just a set it and forget it type of process. It's followed on a monthly basis. And you can see here what the historical allocations look like for this index. And so taking a look at the selection rules here, you can see that it does move around. There's periods where one sector remains historically undervalued relative to other things. There's periods where you jump in and out of sectors. The process has been very active this month. Of the 9 months, the 8 months that we've had the rotation going on this year, I believe it's 7 of the months there's been some change in the behavior. So in a volatile market, it's been able to really help you kind of manage some of that risk, but also go after where those return opportunities are. And if you go back to the inception of the index over a long-term basis, it's been able to outperform the S&P. As I mentioned, it has about a 10-year history now, and that's the anniversary of that. So there'll be some stuff coming out on that. Roughly similar standard deviation, but able to outperform by about 120 basis points per annum. Not an insignificant task in today's market. What have you done for me lately? You can see here that the CAPE index, since we launched it, has indeed outperformed the S&P 500, although, again, it's to that downside of the market. So, if you want to take a look at this on the mutual fund side, we have a smart beta product on that side. We've been running for over 9 years now, or it'll be 9 years at the end of next month, where we've been following this process as well. So long-term value, we think, is there. So with that, we appreciate everyone for tuning in today. Thank you for dialing in and the interest you have in our ETF complex. As we're going to flip to the appendices, I'll take a look at a few questions that we have out there from our listeners today. So just need to move this around. Okay, so a blast from the past. The first question, gentlemen, I haven't heard to you. How are you, Barry? Miss you out there. Would you ever consider share buybacks given now discounts? Barry, wrong webcast. Call us, fundinfo@doubleline.com. But great to hear from you. When do you think the Fed will start raising rate, and at what Fed rate? I think the Fed's committed the rest of this year. I think you're going to get to that 425. And if inflation does not budge whatsoever, they're going to over-engineer. They're going to over tighten and really cause problems. So I think that they're going to hike at the end of the year. I think the bond market's right about that. I'm not convinced that they get to like a 5% rate, but I think 425 seems reasonable to stop us stop at the end of the year. They need to take a pause at some point. We know that operates with a lag. It needs to trickle to the system. So I think that they'll stop around 4.25 to 4.5. I'd like to see them at least pause, give us a break at the end of the year. If you're going to 450, go from 425 to 450 at the March meeting. Again, let's let these things trickle to the system. Thanks for the question. So what macro environment should you favor, the mutual fund or the ETF, and the ETF over the mutual fund? Well, right now, given where the bond market's set up, the mutual fund looks very attractive as well. But again, we believe in the long-term benefits of CAPE. There's some potential tax advantages when it comes to the CAPE ETF. I do own both products. It just depends on what accounts, taxable accounts. I kind of prefer the CAPE ETF at this point in time. And so I have a higher allocation to it there on my personal basis. So next question, good question. How long is the typical lag for the housing data to go into CPI? Our team has done a fair amount of work here, and we find it's about 18 to 24 months. And so what the Fed didn't want to have is because what they've done is they didn't use house prices. They use something called owner's equivalent rate. And so that actually has some other pieces like energy. It has natural gas prices. So there's a lot of different things, a lot of different things going on within there. So it doesn't mean that, we're going to get that 40% cumulative growth that we saw the last 2 years in the housing market. By the way, Case-Shiller data today was a little weak. Month over month, it was down about 55 basis points or so. So the idea behind that process was to smooth that function out because there's volatile components inside of it. And it's really crazy, right? When you think about it, it's like housing should be housing, but it's a survey. It's how much do you think you can rent your house for? They adjust for utilities and things like that. So in the next part of that question is, what do we need to see to be confident the housing component of CPI will moderate? It needs to slow down. And so, I guess that's the obvious answer there. But we think that there's probably another pressure on the housing component for at least another 3 to 6 months, and potentially some of that rent data, if it stagnates. Remember, rents get recycled. They don't have seasonality as much in them as, let's say, the housing market. And so you could probably start to see that pressure on rents first. But again, high house prices means that rents have went up. So it's kind of a cyclical feedback loop within there. So it does take some time. And unfortunately, I think that's the challenge with CPI. Now, remember, the Fed does not look at CPI. They can move the goalposts like they like to do at times. They look at PCE, or personal consumption expenditure. And that has a lower weight to housing. It has a higher weight to healthcare expenditures. So that's what's driving the gap between PCE and CPI today. And so potentially by the Fed focused on PCE, you may get that mitigating effect a little, or the moderating effect a little bit sooner. So very good question, Mike. Thanks for that. Do the job numbers distinguish between full and part-time jobs and the quality? No and yes. So John, your question is a good one, something we've been digging through massively this year on different. So there's something called the establishment survey or the non-farm payrolls, and then there's called the household report. So this is the easiest way to think about it, John. So if you got the establishment survey or the non-farm payrolls, it asks employers, how many people are you employing? Okay, so that's the jobs it looks at. If you go to the household survey, right, and it surveys households. So it says, John, are you employed? It doesn't say, John, do you have 5 jobs? It just says, do you have a job or do you not have a job? So some of the disconnect in those time series you've seen over the last few months, in aggregate, the last 2 jobs report between household and establishment, there's been about a 400,000 cumulative difference between the two. So what that means is that, look, if someone's working part-time and they take on another part-time job, there's another thing you look at. It's like they're part-time because of economic conditions. It can be a skill set mismatch. What you find is the number of part-time jobs as a percentage of overall jobs is below long-term averages. Yes, it's up since the pandemic, but it is below long-term averages. And so that's from the pre-GFC period, even the post-GFC period. So again, a lot of people will say that there's things going on with the job quality out there. it's hard to really see that because of also the wage growth. So great question, something that's hard to disentangle from this, but we've been doing a lot of work on it. What do you think about the risk in private credit market as rates continue to push up and the economic backdrop continues to slow? Well, Kyle, they will get marked down. I've talked to a lot of investors say, well, my fixed income book is flat for this year. What do you own? Do you own just bank loans? What do you own? Well, I own a bunch of private credit. Well, it's not marked, right? Because they haven't had to at this point in time. So I think the private credit is there for a reset. It's due there. But also remember, a lot of private credit is issued at par. And this is what one of our PMs has really been stressing on one of our private placements is that we're buying securities at 20 and 30 point discounts. So not only can we carry similar to private credit in these other placements, and again, these are not for, these are for accredited investors, but you can also have the potential for capital gains as well. So we think that those are kind of structures you should look at. And so again, if you fit those profiles, reach out to us. What DoubleLine ETF or fund can invest to take advantage of the current rates? I just showed you DB&D. You can buy any of our mutual funds that invest in fixed income. They are all mark to market daily, right? They're all at the current market rates. We've been extending duration across our intermediate portfolios this week because, again, we think that the rates market is one that we're starting to pound the table on as well. A great question here. How does DB&D compare to management and D-Flex? Same portfolio managers, same people, different objective. DB&D is meant to be an opportunistic strategy that sits in the intermediate category. That means we have duration bands around the Barclays. I'm sorry, I said it again. The Bloomberg aggregate. D-Flex is more of a credit sensitive product. It tends to be shorter in nature. It's more risky than our low duration product, as you see from the performance. But at time we buy rates. So we did de-risk D-Flex last month. Tune in 2 weeks. I'll show you the comparison of these funds as well as we do our asset allocation webcasts. But D-Flex is one that tends to be more credit sensitive, lower duration in nature. And again, we have de-risked that portfolio coming in to September, which we're quite thankful for given some of the environment. What about EMD? Is it still too early? We believe so. We own a little bit in some of our other asset allocation products, just given the environment with DB&D. We decided because we have small allocations in the other products that it wasn't warranted here. Our EMD team continues to warn us about, look, there's yield there, there's valuation there, but there's still a lot of challenges going forward. And just the strength of the dollar in general probably leads to a little bit of a bumpy ride. Any elections I'm hyper focused on? No, we have to just live with elections. How personally invested in portfolio managers in DB&D? I own some. I haven't bought a lot of it yet. I own a lot of DoubleLine products, but I do own some. So there's an answer to that. Someone says that coordinated stimulus policies from global central banks will be solved through inflation and not being paid back. Is this just the beginning for inflation that could be much longer? And do you think the Fed will change their target to greater than 2? Potentially. I think, given some of this housing data, I think if CPI moderated to 3 and stayed there for a couple of years, I think the Fed would say mission accomplished. So greater than 2, I'd say they'd be comfortable with a 3. They don't want to see a 4 and 5 handle because it's all about tempering expectations. So remember, not only are markets a function of expectations, but so is central bank policy. We've become wedded to forward guidance. We've become wedded to quantitative easing. And what they've tried to do is set expectations for the market. And so as long as inflation and expectations get tempered down, that could potentially have the Fed pull their foot off the accelerator a little bit sooner than they otherwise would. We've seen that in the University of Michigan survey data. You see it kind of in five-year break evens, again, a wonky bond thing. But those are things that probably give the Fed a little bit of cover that the market's not losing control of inflation expectation. And the next question is, and it's the final question, I'll wrap with that. How much more downside could you anticipate in the 10-year from here? 5% or so seems reasonable. And why I say that, the 10-year has a duration around 8. Let's call it today. Maybe it's, let's call it 8. And that says, 8, that's like a 65 basis point rise. So if we got a 2-year to like 5%, which I think is a bit steep, we're thinking maybe more like 450, maybe 475. The curve stays inverted, stays where it's at. That gets you to about a 425 10-year. So We're knocking on heaven's door there. That's why we've been adding a little bit of duration. We've been adding it across the curve, especially on the back end, as we think it's a great way of trying to add some protection to overall portfolios and to get you through this environment. So thank you, everyone. Thanks for tuning in. I know we're about hour 5 into this, so we appreciate everyone's attention to our ETF complex. As I said, I'll be back in 2 weeks. There's a lot going on in markets. We'll update some slides. We'll add some new ones in there, and we'll show you what the DoubleLine team is doing to earn your trust and allow you, try to help you navigate through this environment today. So thanks again, everyone. Thanks for tuning in. Speak to you in 2 weeks.